Let me tell you something nobody in the personal finance world wants to admit. If I had to start over at 35, no savings, no investments, no financial foundation, I wouldn't panic. I'd be relieved. Not because starting over is easy. It isn't. But because 35 is the first age where you have something your 22-year-old self never had, the clarity to do it right. You've made the expensive mistakes. You've dated the wrong financial decisions. You've learned the hard way that income and wealth are two completely different things. And here's the part that changes everything. You still have time, more than you think. 30 years of compounding if you start today. 30 years of that quiet, relentless math working in your favor. But only if you actually start. This video is the exact playbook I would follow. Not the generic advice, not the feel-good motivation. The specific, uncomfortable, counterintuitive steps that actually build something real from nothing in your mid-30s in this economy, in the world as it exists right now. Stay with me, because step 3 is the one most people skip, and it's the one that makes all the others work. First, let me give you a number that will either comfort you or terrify you. The median net worth for Americans between 35 and 44 is $135,600. That's the midpoint. Half of everyone in that age bracket has more, half has less. But here's what that number actually means. If you're at 0 right now, you're not as far behind as you think. Most people your age are not sitting on $500,000. They're just quietly carrying the same anxiety you are, with a few more assets to show for it. Now, here's the other number, the one that matters more. Roughly 80% of Americans say they wish they had started investing earlier in life. Not 30%, not 50%, 80%. 4 out of every 5 people look back and wish they had done exactly what you are considering doing right now. The difference between you and them is this video and what you do after it ends. So, here's what I do. Day 1, year 1, the whole thing. The first thing I do is nothing. For 30 days, I would not open a brokerage account. I would not research stocks. I would not read Reddit threads about crypto. I would do a complete financial autopsy. Every single dollar coming in, every single dollar going out. Not an estimate, the actual numbers pulled from actual bank statements for the last 3 months. Here's what this audit almost always reveals. There's a 15% to 25% leak. Subscriptions you forgot. Lifestyle expenses that silently inflated over time. Spending categories that, when you see the actual number in writing, make you genuinely embarrassed. That leak is your starting capital. Most people try to build wealth on top of a broken foundation. They open a Roth IRA and simultaneously pay $340 a month in subscription services they haven't used since 2023. They invest $200 and drain $400 in financial friction. They never bother to audit. The audit comes first. Always. Once you've found the leak, you redirect it. Not to investments yet. First, you build a 1-month emergency buffer. 1 month of actual expenses sitting in a high-yield savings account. Not 3 months, that comes later. 1 month first. Because the single biggest enemy of new investors is having to sell their investments in a crisis. You protect the strategy by protecting yourself first. Now, this is where it gets uncomfortable for people. At 35, starting from 0, the single non-negotiable move is you build the money machine before you build the lifestyle. What does that mean? It means your investment accounts grow before your apartment does. It means your Roth IRA maxes out before your car payment goes up. It means for the next 36 months, every raise you get goes into the machine, not into an upgraded version of your life. This is the hardest instruction in this entire video, because at 35, you feel the pull. Your peers are buying bigger houses, taking better vacations, driving newer cars. Social comparison at this age is vicious. It's quiet and constant and expensive. But here's the truth they don't tell you. Most of those people are building a beautiful looking set with no structure behind it. The house, the car, the vacation, it's all debt and optics. It's not a financial foundation. It's a financial performance. You're building something different. For the machine itself, in 2026, you can contribute up to $23,500 to a 401k and up to $7,000 to a Roth IRA. If your employer matches anything on the 401k, you take that match first. It is the closest thing to free money that exists in the legal financial system. Then you fill the Roth. After tax dollars in, tax-free growth forever. At 35, with roughly 30 years until traditional retirement age, the Roth IRA might be the single most powerful instrument available to you. What do you put inside it? This is where I would fight the instinct that costs people the most money. Just 21% of actively managed funds survived and beat their index counterparts over the 10 years through June 2026. Read that again. 79% of professional fund managers, people who do this full time, with research teams and algorithms and decades of experience, failed to beat a simple index fund over a decade. Only 14% of actively managed US large cap funds beat the S&P 500 over the past 10 years. If 86 out of 100 professionals can't do it, what makes you think you starting from zero at 35 with a full life and a full-time job are going to pick the right one? You don't need to pick. You buy the whole market. Low-cost index funds, total market exposure, automatic monthly contributions. Set it up once, never touch it, let the machine run. This is not exciting. It is also how wealth is actually built. Here's the rehook. The thing most people skip because they're still thinking about the first two steps. Your salary is not your wealth. It is the raw material from which wealth is made. This distinction sounds simple. It changes everything. Most people treat their income as the goal, the finish line. Get a raise, achieve comfort, stop worrying. But income without a system is just a faster leak. I've seen people making $250,000 a year with less financial security than someone making $80,000 who built a system in their mid-30s. At 35, starting from zero, I would dedicate a portion of my energy to creating a second income stream, not a side hustle that exhausts you. A leveraged income stream, something that doesn't require proportional hours for proportional output. This might be digital products, consulting in your area of expertise, a rental income situation you build toward, content, licensing, royalties. The specific vehicle is less important than the principle. 88% of Americans believe you need passive income to be truly financially secure in retirement. And 83% say multiple income streams are essential, not optional. Essential. The second income stream does something specific for someone starting at 35. It accelerates the timeline. Instead of 30 years to financial freedom, it can become 18. Instead of retiring at 67, it creates the option at 55 or earlier if that's what you want. You don't build it overnight. You build it consistently over 36 months alongside everything else. The machine runs automatically. You spend 5 hours a week on the second stream. You don't expect results for 12 months. You plant it anyway. There is one more thing I would do that almost nobody talks about in financial videos. I would invest aggressively in myself, not motivational poster style. I mean specific, strategic, high return skill acquisition. At 35, you have something a 2-year-old doesn't. You know your industry. You know what actually moves the needle. You know which skills are undervalued in your field and which ones command disproportionate compensation. The average American made their first investment at 27 years old. Most of them invested in markets they didn't understand, with money they could barely afford, without the professional experience to put returns in context. You're different. You know enough to make a targeted bet on human capital on the 3-month course, the credential, the specialized knowledge that takes your income from a 4 to a 7 on the leverage scale. And that income feeds the machine, which compounds, which builds the life. This is the step that compounds twice. Once in your earnings, once in your investments. It is the multiplier that makes everything else go faster. I want to close with something that doesn't get said enough. 35 is not a disadvantage, not even close. The average American made their first investment at 27, and most of them made it with no idea what they were doing, in assets they couldn't evaluate, driven by emotion rather than strategy. Most of that money got scared out of the market in 2020, or 2022, or whenever the next crisis hit. Starting at 35 means you've watched other people make the emotional mistakes. You've seen what panic selling looks like. You've learned, without paying the price, what overconfidence in individual stocks costs a portfolio. You start with scars that teach rather than scars that cost. You also start with something the data confirms is underrated: earned income at peak productivity, combined with enough life experience to actually protect and direct it. Investing $500 a month, starting at 35, with a 7% average return, still builds a substantial 7-figure portfolio by traditional retirement age. The math still works. It works with less margin for error than starting at 25, which means the system has to be right. But when the system is right, when it's automated, indexed, diversified, and protected, the math is ruthlessly effective. The people who fail at 35 are the ones who try to make up for lost time by taking disproportionate risk, who put it all on a single stock because they feel behind, who skip the audit, skip the emergency buffer, skip the machine, and go straight for the moonshot. That's not starting over. That's starting wrong. Here's what I know about the person who watched this far. You're not looking for permission. You're looking for a plan. You don't need someone to tell you it's going to be okay. You need to be shown that there's a specific path, one that has actually worked, built on real math, designed for someone exactly where you are. That path exists. It starts with an audit. It runs through an automated machine. It grows through a second income stream and a targeted skill investment. And it is powered by the single most underutilized asset of someone at 35, the clarity you now have about what actually matters. Most people spend their 20s figuring out who they are. You did that already. Now it's time to build. The only question is whether you start today or whether you become one of the 80% who 10 years from now wishes they had. That choice is yours. Right now, today.